Hi, Steve Harper here. I am lead educator and co-founder at Straight Talk Schools. And I've been for years educating both the investor and the real estate professional as it pertains to commercial real estate and investment real estate in general. And if you are a real estate professional and your intention is to add either investment real estate or commercial real estate to your book of business, then 1031 exchange is something that absolutely has to be in your vocabulary. And several of my students over the years have said, Steve, I'd love it if you put something together that was just a quick presentation, not your hour or your 2-hour program that goes all into 1031 exchange, but something that just boils it down in a 5 or 10 minute video that helps the regular real estate professional go ahead and understand 1031 exchange enough to get out in the field and start practicing and know what to do with a 1031 exchange client immediately. So what I did is we put this presentation together. It's for you, and I hope you enjoy it. So to begin with, what I want to take you through is 1031 exchange and what it is. And a 1031 exchange is just a section of the Internal Revenue Code that allows an investor to defer taxes for a period of time, sometime in the future. You may have seen it as a tax-free exchange. You may have heard of that. You may have heard of Starker account. None of those things are actually the case. It's a tax-deferred exchange. Now, it can be deferred inevitably the way the tax laws are written right now. And if you're interested in getting into more of the nuts and bolts like that, make sure you look for our classes, which you can always see at www.straighttalkacademy.com. But in the meantime, let's go ahead and finish this up. Now, in a nutshell, a 1031 exchange allows an investor to sell their property and then not have to pay the long or short-term capital gains, depreciation recapture. They basically just take their protection from one property and it puts it into another property. Now, there's a lot of rules that they have to follow in order to make that happen, and there are definitely some rules that they cannot break in order to make that happen. So what I'm going to take you through today is, again, just the most common practice and enough to get you out there and get you started. I'm going to take you through the steps of a 1031 exchange. I'm going to take you through the most common type of 1031 exchange used today. I've been doing and helping folks with 1031 exchanges. Now, I am not an accommodator. I am not a 1031 exchange company, and I'm not going to be one. I utilize 1031 exchange companies, and as a matter of fact, I'm going to give you the contact information for some of the 1031 exchange companies I've used over the years at the end of this particular presentation. So we're going to go over the most common types of exchange and the 3-property rule, which is the most common identification rule utilized in 1031 exchange. So to begin with, what a 1031 exchange can do for you or your client, it's going to defer the federal income taxes on your real estate transactions. Now that includes long and short-term capital gains. But many times an investor forgets to think about depreciation recapture. So don't ever forget. I myself do not give financial advice, I don't give legal advice, and I don't give tax advice. And you as a real estate professional should do the same. So make sure that you understand enough about 1031 exchange, but your ultimate answer is always going to be, hey, you know what, I need to get you in front of my 1031 exchange expert. Or, hold on a moment, let's get my 1031 exchange expert on the phone so that we can go over your particular situation. That's going to always be your default answer. So some other things, some other advantages of a 1031 exchange is they allow the investor to actually grow their portfolio much quicker and larger than they could if they were having to pay taxes every time. It would really put them behind the 8 ball in growing their particular wealth for whatever reason they're growing it for. Maybe it's retirement, for college, maybe it's just to grow wealth, whatever. This will help you do it. Then there's also some advantages that you can actually convert a rental into a personal residence, and you can take some favorable capital gains treatment. But again, if you're going to do that after a 1031 exchange, you do need to consult with your tax advisor or your CPA before you do that or before you advise a client to do that. But those are things that can be done. Steps to a 1031 exchange. I want to break it down really easy for you. I did not put a lot of the legalese that you're going to see in a lot of 1031 exchange presentations into this particular slide. I just want to use some straight talk, some real world talk on how it's going to work, or what are the steps to a 1031 exchange. The first step The moment you think someone's going to 1031 exchange, and if you're dealing with investors, you as a real estate professional always need to be asking the question of your clients, is this potentially an exchange? Are you going to buy another property? And if you're not going to buy another property, why aren't you going to buy another property? What are you going to do with the proceeds? Have you thought about capital gains, either long or short term capital gains? Have you thought about depreciation recapture? And most importantly, have you run these ideas past your CPA or your financial advisor? These are questions you want to ask. But the first thing you want to do is contact a 1031 exchange company as soon as possible. Sooner the better on that. Before you've sold any property, do not think that you can close on a property and then set up a 1031 exchange while the money's sitting in escrow. It doesn't work. So you want to list the current property for sale after you've contacted the company, or maybe it's already listed. Hopefully you called them beforehand. You want to sell and close the first escrow. You want to identify your replacement property within the first 45 days. And again, this is the most common 1031 exchange. And you want to close on the replacement property within 180 days total from the time you sold or closed escrow on the first property or the relinquished property. And that's it. That's including the 45-day period. Now that's it. That's the entire steps to the most common 1031 exchange. So what is a qualified intermediary? Because a qualified intermediary is terminology that you need to become familiar with, because your clients are going to be asking you about this and how this 1031 exchange works. I want to make sure you know that too. The qualified intermediary is basically that company who's going to facilitate the 1031 exchange, and the QI cannot be a disqualified person, which we can go into in great detail in our full-blown 1031 exchange class. But in this case, it can't be a disqualified person, and it cannot be the taxpayer. You cannot do your own 1031 exchanges. It doesn't work that way. So what does a qualified intermediary actually do? What does a QI do? The QI basically does a couple of things for you. All that happens on a 1031 exchange is really the QI is the person that's going to be designated to actually sell your property for you, hold the funds for you, hold them the way they're supposed to be held, buy the new property for you the way you want it bought, and then put it back in your name. That's ultimately what it comes down to. And if you're looking at the three definitions on your screen right now, that's what that means. It just simply means that before you close on the property you're selling or your client is selling, it's actually going to be assigned to the qualified intermediary. They're now going to own the property. They're holding it in trust for your client. Then they're also going to sell the property and close it. They're going to hold the funds. They're going to make sure they're not commingled or anywhere they're not supposed to be. Then they're going to go ahead and buy the replacement property on behalf of your client or yourself. And then they're going to put it back in your name, and then they go away on down the road. That's all that happens in a 1031 exchange. Now, the types of exchange, there are 4 types of exchange, and we're only going to talk about one. We're going to talk about most common. I've done this for a couple of decades, and I will tell you, only been a handful of times I've done anything other than a delayed 1031 exchange. It is the most common 1031 exchange that's utilized. But there are also reverse exchanges, there are improvement exchanges, and there are simultaneous exchanges. These are other types of 1031 exchange, each of these that have their own set of rules with them. Now, if you're interested in hearing about those, again, check out our full-blown 1031 exchange class available at www.straighttalkacademy, that's ACADEMY.com, and you can certainly see that. But again, those are the most common types. So those are the types of exchanges. Now, all we're going to talk about today is the delayed exchange. So with the delayed 1031 exchange, there's some dates that are super important that you need to remember. There's 2 time periods that you got to know about. And that is 45 days and 180 days. That's what you need to know about. The reality is, and if you're looking at your screen right now while I'm talking, that's great. From the day your relinquished property or the property you're selling or you're selling on behalf of your client closes, from that day, that's day 0, you've got 45 days to identify whatever your replacement property is going to be. Now, you also, from that day 0, have to close escrow on whatever you've identified within 180 days. These are hard and fast rules. 45 and 180 days. You need to know these, and you need to know that these are hard, set in stone dates. They are not going to be changed. They're not going to make exceptions for you. In any case, it's not going to happen. With the 1031 exchange and the delayed exchange, some things that you do want to consider. And I want to tell you a couple of stories. Number one, you cannot change the time frame. Did I say how important the 45 days and the 180 days were? Because they are super important. I will tell you, feast, famine, flood, my dog ate my homework. None of those excuses is IRS going to accept. When Hurricane Katrina hit, which we all know was completely devastating, that is the first time in history that I've ever known the IRS to grant an actual extension of either the 45 or the 180 days. But of the 2,000 or 3,000 requests they got, I think they granted 2 or 3, and those people literally closed within the next day or two, even after Katrina hit. So those dates are hard and fast, and you don't want to forget that. And that's basically what a 1031 exchange is. And now again, if you have questions or comments, if you are an investor or you're a real estate professional looking for some education, maybe you want to add commercial real estate to your existing book of business, then check us out at www.straighttalkacademy.com, or shoot me an email or call us at info@straighttalkacademy.com, or you can call 702-843-0579. Thank you very much for listening, and I hope to see you soon.